Hello.
Hi,
Akhilesh. Oh,
hi,
both.
how are you?
Hi.
Hello there. Hello.
Oh man, Akhilesh, yeah, yesterday, job well done, honestly.
Thanks.
Good questions.
I had no choice, dude.
No, but you really did it well. I was telling Aryan also.
Nah,
What-
last
I
question.
was like, I'll text you aram say on WhatsApp.
That's fine. Thanks, man. Appreciate it. I mean, I would appreciate some constructive criticism if you've got any.
Can you talk a little bit louder here?
Yeah, I put my mic up like a dumb. So no, I don't know. I'd love some constructive criticism if you've got any. So
Honestly, no, not from my side. No.
I then I shall wait. I'll wait. I think Daksh and I changed setup. Now he's in the dark and I've got light.
Only if I had them disco lights. Yeah.
Ooh, you ordered them, right? They arrived?
Maybe I can play something on my monitor and then it's gonna reflect light.
Yeah. It's actually good trips with it. Hi Josh, hi Wazifa.
Hi, how are you?
Good, thank
What's up?
you guys. What's up, Josh? We're
Not
playing
bad.
Real
Thank you.
Madrid,
How
man.
are
We're
you?
playing Real Madrid. Let's see how it goes. Are we gonna get out or not?
Let's see. Let's see.
Oh no. Oh no. Hi Sanskruti.
Hi, good morning.
Morning, how are you? And we've got Chirag and Ishat as well. Hi guys. Hi Alan. Hi Mira.
Hey, good morning.
Good morning. Hi
Hi.
Abhi. Abhimanyu. Hi.
Hey, what's
Hi
up?
Adil. Hi Loka.
Hi.
So 33 more days until you guys find yourself a new host. Finally,
Are you gonna come back to Dubai anytime soon, Bachir?
not so sure. Let's see. The only shot I got at coming back to Dubai is probably after April, post April, and probably May or June. But let's see. Depends on the market. So let's wait for a couple more minutes. It's still 11:01. Although I thank you guys for being on time. Hi Ronit, how are you? Just noticed you, sorry.
Hi, good morning, Akhilesh. How are you?
I'm good. What about you? Impressive resume, I must say, and I'm inspired.
It's still very small.
I mean, trust me, working for CNBC, if for you is small, then I mean, God wonders how big are your dreams. Good though. The first thing I got right on Google after Googling your name was a picture of you on CNBC. I'm like, okay, now this is next level. It's truly an honor to have you here.
Thank you so much. It's an honor to be here because, I'm teaching for the first time. So I hope I'm good and I'm not fast enough for you guys.
Let's just say it's not teaching, it's more, a conversation.
Conversation, yes.
But we'll be a little more passive. Although I request everyone here, come on guys, let's engage a bit, ask the questions. There's probably the guy who we dream to become one day. So
Your bar is too low then.
nah, trust me, it's high enough. It's high enough for me. I'm happy.
So when can have a conversation, just stop me wherever I'm going fast. You can ask me doubts in between. You can make this as interactive as possible so that, we all learn.
Sure. How's your journey at SPJN been so far though? I'm curious.
It's been fairly good because I think we have really good professors because we have professors who have worked in the industry, so that helps us a lot in terms of understanding the practicality of what we are learning compared to just theory. So that's really helpful for us.
It's cool.
What about you?
Doing great so far. I've got 33 days left.
Oh,
So I'm counting my days now at SPJN, but grateful for the really good 3 years I've spent here. So you're someone from an investment background, research background, and I would even qualify you as an economic journalist because of your research background. You've got like 4.5 years buy side, sell side, media, and everything related to investment. So it's what usually is pretty niche for most of us is actually your specialty and your domain. So I know we're going to be blown away by whatever you say today, but the floor is now entirely yours. So I think we can begin.
thank you so much. So I'm sure all of you all have heard about, in your first session, the fundamentals of investing, or at least some of that. So I'll just try to, brief touch upon, what is investing, how you can at least the basics, what can you do, how you can analyze a company, what type of ratios you can use. So I'll just share my screen. Where is
Just a disclaimer out here. We're actually learning how to make money. So everyone who wants to be rich, come on, guys. Attention.
Yeah, so it's all the billionaires, right? You know how they make their money. It's all in the stock market. All their money is actually a prerogative of equity investments. That is, say, Jeff Bezos. How is he worth, billions? Is because of his share in his company, that's Amazon, that's listed on the stock market. And you can become an investor too with that. So I'll just I'm going to brief explain how we can analyze companies looking at various parameters. So basically, I think all of you have already understood. Just make it full screen. Give me a minute. So can you all see my screen? Okay, so I'll
Green
go ahead.
lights, green lights.
Thank you guys, for giving me the opportunity to at least, present and, have a conversation with you guys of what I've learned over the past 7 years since, I've been in the stock market as well as investments. So this is a brief about me. I'm the GMBA batch of 2022. We have just finished close to a month, 1.5 months at SP Jain. We are currently in Dubai with our offline schooling is going on for us. So I've been trading and investing since I was 17, right before I have a PAN card. A PAN card is basically a card that you need, to open a demat account where you can buy or sell shares. I've been trading, with my sister's account before I got that. And then since my college days, that's my pocket money. So you guys, if you need pocket money, you know where to go to, but also you can lose your pocket money as well. So I worked as an analyst at an investment fund for the past 2.5 years before joining SP Jain. So as an analyst, you're in charge of certain companies and certain sectors, wherein you have to be a domain expert in that sector, so that when your boss, that is your fund manager, comes to you and asks you certain questions, you should know, basically how to answer them, and you need to know about that sector. Before that, I worked at CNBC TV 18, which is India's #1 business channel. I worked there for close to a year. And there I used to come on air and talk about stocks, talk about different sectors every morning. So my day used to start around 6 o'clock in the morning. So reach office by 6:45, and our day used to end by 3:30, 4 o'clock. That's when the market closes in India. But then we come back home and we again have to start working on, whatever things are happening post market. So basically it's like a almost a 16 to 17 hour job, especially during earning seasons. I'll come on that later. So basically, what is investing? Investing is basically buying a share of a company. It's one part of it. And how do you analyze that company? So the only way to analyze a company, or one of the ways to analyze a company, is looking at the financial statements. And in the financial statements, as you guys already know, there's a profit and loss, there's a balance sheet, and there's a cash flow. So I'll touch upon, what we can see in a balance sheet. How do we read a balance sheet? And, if you can already guys read what's on the slide, so I won't repeat the same thing. If you guys are done, I'll move on to, the next slide. So I'll just give you a brief upon the balance sheet. And I'll tell you what type of subsectors are there in the balance sheet so that you guys can at least understand. So all you guys are, understanding till here, right? Is everything okay till here? All good? Okay,
I
I'll
think
just...
it's good up till here.
Yeah.
You can go ahead.
So, the balance sheet comprises of 4 different things. So you have assets and liabilities. Under assets, you have current assets, you have current liabilities, you have current assets, non-current assets, current liabilities, non-current liabilities. So what are current assets? So basically, I'll give you simple examples. If you're running a business, you have some cash in your bank account that comes under current assets. That means you're going to use that money in the next 1 year, either to run your business or you need to pay your suppliers. The second thing is your account receivable. So basically, I'll give you, I'm running a business. I sell goods to you, but you haven't paid me on time. So what happens, that comes under my accounts receivable. So I've given you the goods, but I've still not got the money from you. So in the balance sheet, that comes under account receivable. So that means someone still has to give me the money. And so in any business, when you're analyzing a business, you always have to look at the account receivables. And if the account receivables are high, you have to dig into that business and find out why the account receivables are high. Sometimes businesses will just keep on selling goods, but they won't collect, the money from customers. And that creates a lot of problems for businesses going ahead. So another thing is the short-term loans and advances. What you look as, companies that sometimes give money to their suppliers or to their creditors or anyone, they can give it under short-term loans and advances. And finally is your inventory. So if I'm running a restaurant, the vegetables I buy, the spices I buy are all comes in my inventories. So this, is the basics of a current asset. So whenever you look at a balance sheet, you'll always look at these items and you'll see how large or how small they are in relation to the entire balance sheet. So I'll move to the non-current assets. So this is fairly simple. Non-current assets are basically assets that have been there in your balance sheet for more than 1 year. So, basically you build a factory, that's your long-term asset. You have land in your balance sheet, that's again a long-term asset. So again, different businesses have different types of assets on the balance sheet. For Amazon, for instance, will have, really, low amount of non-current assets on their balance sheet versus a Tesla that's building cars. They'll have really high, amount of assets. That is, they'll have their factories, they'll have their robots, that manufacture their, cars. So I'll come to how to interpret this, but this is just the basics of what is there in your balance sheet. Now you go to the current liabilities. This is your short-term debt and your customer advances. So you're thinking, why is customer advances a liability on your balance sheet? Someone's giving you money but you haven't given them their service yet. So for you, it's still a liability until and unless you deliver the goods to them. It's a liability on your balance sheet. And short-term debt is simple, right? So now I'm running a business. I get a big order, but I don't have the money in my bank account to make those things that I have to deliver for the order. So I go to the bank. I tell the bank, guys, I need a loan. I need to make a product for my order. So they come and give me a short-term debt. So as soon as I finish the product and I sell it to someone, I get the money and I repay the bank. So that is my short-term debt. So this is usually called working capital. Working capital, if anyone runs a business, I'm sure they'll know what is working capital. Basically, the money that you need to just run your day-to-day businesses. You can pay salaries with it, and you can pay your suppliers. So this is your working capital debt. Now moving on to your liabilities. So, every business has some type of liability or not. So I'll give you an example. Tesla, if they have to build a factory, they have to take a loan from a bank. How do they take that loan? That comes under their long-term debt. And some businesses long-term debt is good for them, some businesses long-term debt is not good. If you take a metals company or a steel company, these guys build factories, really large factories, which they spend 6,000 to 7,000 crores on them. I'm sure everyone knows what 6,000 7,000 crores are, since we all are mostly Indian over here. Is that good? So basically it's $1 billion where you take on so much debt, and that comes under your long-term debt in your balance sheet. So when you're analyzing a business, you also have to look at the long-term debt and see if it's high or low. Now moving on to pension obligations, basically, these government companies have employees working with them, and they have to pay them pensions over a specified period. So that comes under liabilities. And your long-term leases, again, if you own or if you're running a business and you are leasing the premises of your business, like SPGen, for example, if they don't own the building that they have in Dubai Academic City, that comes under their long-term leases. So that was basically your balance sheet, a very simple explanation of your balance sheet. But now coming on to your income statement. Your income statement basically starts at the top, that is your revenue, the amount of sales that you make. And I need to tell you guys also, there'll be a quiz at the end on Kahoot. So I hope you guys are just remembering what I'm saying, so that this helps you. And I know that your guys are paying attention. And with the quiz marks, I'll at least know if I'm good enough or not, and at least imparting some basic financial skills. So basically, the income statement is your revenue. I'm sure everyone knows what's your revenue. It's your sales of your business. And after that comes the inventory that you use in your business. As we use the example in a balance sheet, the inventory, that is the goods that you use to make your final product, that comes under your inventory. And after that, there's something called gross margins. So every industry has different gross margins. Gross margins is basically a revenue minus your inventory that you've used. So when you're looking at a business, like in investment, I think you'll have a case that you'll have to do. You have to look at the gross margins of the business and look at it over the last 5 to 6 years, and see how the growth or how the trend has been in the gross margins. Ideally in a good business, it should be increasing. In a business that is facing problems of pricing power, the gross margins will be coming down. After gross margins is your other expenses in your business, be your power and fuel, your employee cost, your selling admin expenses. And one important term that you will use a lot is called EBITDA. So what is EBITDA? EBITDA is your earnings before interest, tax, depreciation, and amortization. So basically an EBITDA is the actual operating profit of a business. And whenever you're using in your investment case, you have to look at the EBITDA margins of such a business. If you have any questions, guys, you'll just interrupt me and you'll let me know. So, when you're analyzing your case, you have to plot the EBITDA margins over the last 10 years and see how the business has been doing, and you compare it with other companies in the same business. So this really tells you how good your company has been in the last 10 years in terms of their margins. Then after that comes the depreciation, interest. Depreciation is basically when you buy a building, right? The value of your building usually doesn't go up. You have to spend money on, repairing the building, on putting lights, on repairing the lights. So that comes under a figurehead called depreciation. And your interest obviously is the interest that you're paying on the loan that you have taken. And after you deduct all these expenses, you get something called PBT. What is PBT? Simple, like profit before tax. So this usually you will use to again compare with other companies. And finally, you deduct your tax and you get your profit after tax. So this is the profit that the company is making. So many expenses of a company. Sometimes people get confused, right? The revenue is equal to the profit, but that's not it. Revenue is just the top. You have a lot of other expenses that you have to account for in your income statement. And finally, you come down to the PAT. You see this business over here in 2011 has made 1,275 crores of revenue, but their actual PAT is only 8%. So no, it's very important to see your PAT margins in relation to your revenue so that you can compare it with other companies. Tesla, for example, may be making a high margin compared to say a Toyota or compared to a Nissan. So it's very important to see these PAT margins and you'll know how strong the business is. Are they making good amounts of money? So this is basically our income statement. So, there are a lot of terms that are used in investing. Like, if you watch CNBC, you'll have something called the shareholders. Shareholders are basically the owners of the company. How do they become owners of the company? There's something called the stock market. So when you go and you buy a share of a company, you become a part owner of that company. It'll be 0.0001%, but it's still a shareholder, right? Revenue, as we discussed, is your revenue that you get from selling your products. Your gross profit, we have already discussed, is your revenue minus your cost of goods sold. Your cost of goods sold is basically your inventory. We have discussed EBITDA. So it's earnings before interest, tax, depreciation, amortization. It's a very important term. You'll come across this term a lot if you're into investments or even if you run a business. This term is used a lot. So if you really want to sound smart, you just have to tell them my EBITDA margins are so and so. And if someone comes and presents you an investment case, you just need to ask them how has been your EBITDA trend. And that's when you will come to know, how the business is doing. Market cap. So what is market cap? You've heard how Tesla reaches a new 1.5 billion, 20 billion, 30 billion, 60 billion market cap. What is that? That's basically the worth of the company on the stock market. So when you want to look how a company is or how big a company is, you go to the company's webpage and you'll know their market cap. And this will tell you how big or how small the company is. So any company more than like $3 billion, that's 18,000, 21,000 crores, they're a big company. Anyone below that is a mid-sized company. And any company below, say, $500 million is a small cap company. So with the market cap, you know what type of company you're dealing with. Is it a large cap, mid cap, or small cap? Dividend. So, as we discussed in the income statement, there's something called the profit after tax. So, the shareholders have a right on that profit after tax. So they get something called a dividend that the company, distributes to them either every year or every other year. And, apart from the money that you're purchasing, you get dividends in your bank account. So Jeff Bezos, for example, owns, say 20% of Amazon. The profit that Amazon makes, he has a right on that. So what happens is the company will distribute profits to him and he'll get, profits in proportion to the profit after tax of the company. So the price, what is the price? The stock price of the company. You all must have seen, prices going up and down, and on CNBC or any other business channel, when someone talks of the stock price of the company, it's a derivative of the market cap. So when you say Tesla hits all-time high at $700, that's basically the stock price of the company. So when you look at the stock price in isolation, you'll feel it's very volatile, and that's how usually it works. So what is IPO? You must have read like there are a lot of IPOs coming out in the last 3 to 6 months. IPOs is first basically when a company lists for the first time on the stock exchange. It's called an IPO where they're distributing shares to the investors for the first time. Investors purchase these shares. So these are the terms you'll come across in your investing journey. See, I know not everyone wants to become an investor or make a career out of this, but this is very important in your personal finance. What will happen is once you have a salary, you have to allocate that money somewhere, because you'll get only 4-5% in the bank, whereas you will get much more, say, in the stock market via mutual funds, which will be around 11 to 12%, which is almost 3 times what you'll get in your bank. So it's very important to know these terms when you're analyzing a company. So we discussed the balance sheet, but in the balance sheet as well, there are certain ratios that will tell you whether the company is good or bad, and you can compare it with other companies. The first one is the debt to equity ratio. This is fairly simple. Is your short term plus long term debt that the company has taken upon the shareholders' equity. Now, I can't go into detail into all this, but you should just remember anything above 1 to 1.5 is high. Anything below that is very good. So any company that has a debt to equity ratio above 1.5 to 2, that company has a lot of debt on its balance sheet. So the interest coverage ratio is your operating income about your interest expense. What is operating income? Your EBITDA. So any ratio, about 3.5 is again really, expensive, and it'll be negative for a company. These are just, I'm giving you thumb rules so that when you look at the interest income or you look at the interest coverage ratio, you know if it's high or low. Just looking at an isolation will not help you, but at least you know whether the company has a lot of debt and they're able to service that debt or not. And the asset turnover ratio is fairly simple. So, SPGen buys a building in Dubai for 100 crores. Whereas the revenue that they're making from the students who are coming, they're making 200 crores. So it's basically your revenue upon your average total assets. So 200 crores upon 100 crores. So that's 2 times their average turnover ratio. So again, an average turnover ratio, the higher the better. And that is one thumb rule you have to remember. Inventory turnover ratio, again, it's, the goods that you buy. So you're buying vegetables to sell. So you buy those vegetables upon your total inventory. Again, in this also, the higher the better. That means the inventory that you have is getting sold fast. If it's a low inventory turnover ratio, that means you're getting stuck with all the vegetables you have and they're getting spoiled. So it's just a very simple example. Now receivables turnover ratio again. So now I make a sale to a client of mine, but he's not paying me. So that means my net credit sales on average account receivables will be very high. So this ratio, the lower the better, so that you're getting your money on time. So now that was more related to the balance sheet. So now I'll talk about the profitability ratios. So these are fairly, gross profit upon net sales, as we discussed in the income statement. This is basically, will tell you the gross margins of the company. The operating margin will tell you how good or bad the company is doing, what is their pricing power. Say a restaurant business may have a low operating margin, but a company like Tesla will have a high operating margin, so that you use this as a hand to figure out if the company is doing well or not. Your return on assets, basically the amount of money you're putting into the business to buy assets and the profit you're making, is a return on assets ratio. So in this also, the higher the better. And any company should have a high return on asset ratio. And now your return equity ratio also is your net income, that is your profit after tax, upon the money your shareholders have put. So basically, if you start a business, you put in some money, right? You put in, say, 1 rupee, and in your first year itself, you're making, 0.5 rupees. So, return equity ratio will be around 50%. So in return equity ratio, so in your profitability ratios, the higher the better in any ratio. That means your business is doing well. Now we'll come down to, this is what an investor uses. So this, you will be using a lot of this in your investment case studies. So basically a price to earnings is the market cap, as we had discussed, is the total worth of the company about upon the profit the company makes. So, in isolation, this won't tell you anything. Tesla, for example, may have a price to earnings of 50 times. Now you don't know if that is high or low. So what you will do now in your investment case study, if you have Tesla as an investment case, you will go to other companies in the same sector. So you have Tesla, you have Toyota, you have Chrysler, you have 3-4 other auto companies, and you'll compare the price to earnings of each company. So for each company, the formula will remain the same, the total worth of the company on the stock market upon their profit after tax. That way you come to know if the company is cheap or expensive. So Tesla at 50x versus say a Toyota at 25x, that means Tesla is much more expensive compared to Toyota. But again, this has a lot of formulas which if you read and you'll understand, sometimes a higher PE ratio may not be good, or a higher PE ratio, that is price to earnings ratio, may be also bad. So strong companies usually have a high PE ratio. If you look at Amazon has just started making profits in the last 3 years, but the company has still been doing well. That means, the PE ratio was 100, 150, 200 times. So if you look at such a high PE ratio, you'll say it's very expensive. But you also have to look forward and see how the company is doing, what the company will do 2 years down the line, 3 years down the line. That's what how we'll use. That's why you'll invest, right? If the company is going to do well in the next 3 to 4 years, that's why you'll invest in the company. You're not looking at the past, you're looking at the future. So as I said, can be used to compare companies in the same sector. Never look at the P ratio in isolation. Always compare it with companies in the same sector. P ratio depends on the growth of the company. The higher the growth, the higher the P ratio. So a company like Tesla will have a high P ratio. A company like Walmart, that has been there since the 1980s in US, has a lower P ratio because the growth has slowed down. Now this is a little complex, so I won't spend too much time on this. So this is basically what we use in investing is called EV/EBITDA. EV is basically is called enterprise value. Enterprise value is the market cap of the company, that is the worth of the company, plus the debt the company has. So basically, when you're buying a business, suppose you're going to buy 100% of SP Gen, you're going to buy SP Gen's company worth plus the debt that they have on their business, right? You're not just going to get SP Gen and say, oh, they have no debt, I'll just buy the buildings, I won't buy anything else. But when you're buying SP Gen, you buy the whole of SP Gen, that is what the company is worth on the stock market plus the debt that they have, because you have to repay that debt. That debt doesn't get off your balance sheet. So this is used to compare companies with really high debt. So there are these metal companies, say a Tata Steel. I think all of you have heard of Tata Steel in India. So Tata Steel basically is a metal company. So for metal companies, they make steel. So they have capacities around 20 million tons. So to make 1 million ton capacity, it costs an average $1 billion. So for them to make their money back is going to take them at least 7 to 8 years on each plant. So when they're investing so much money, these companies don't make any profit. That means they don't make any profit after tax. So in these companies, they have to use something called an EBITDA. That is their actual operating profit. So that is why you use this ratio called the EV EBITDA. So any company that you have the investment case study, if it's loss making and if it has high debt, you won't be able to use something called the PE ratio, that is the price to earnings. You'll use the EV EBITDA ratio. If you Google, you'll find a lot more on it. So I won't focus too much on all this.
Sorry, what does EV stand for?
Enterprise value.
Right. And those values are based on, how do you derive those values?
So you have the market cap, which I've explained before.
Yeah.
So you have the market cap plus the debt of the company.
Okay.
So the company usually has some debt on their balance sheet minus their cash. So what happens is when you're buying a company, right, you will buy the whole company. And if there's some cash on the balance sheet of the company, you can take that company and you can use that cash for something else. So that is why you minus the cash from the EV ratio. All this, there's a lot of it on the internet. So you can always search and,
Yeah.
use it in your case studies.
Got it. Thank you.
So this is usually, how you will see the key financials of any company. I've taken this from a brokerage report wherein they plot. So you're given 3 years of historical numbers, FY17, FY18, and you're given 3 years of forward numbers. The E stands for estimate. So this basically is an estimate of what I think the company will make in FY20 and FY21. And I know all these ratios, and now you can see how we use the valuation ratio and the operating ratios, right? So the valuation ratio, see how the valuation ratio was 83 in FY17. That means it was really high. That means the company, had some problems or their profit after tax was not high enough. If you see the net profit was only 221, that is 22 crores. And how it increased and the PE ratio goes down. So basically these two are related because the PE ratio is what the market cap upon the profit after tax. So you have to, this is how, your key financial summary will be whenever you're making investment case and you have different, ratios on the left. There are many ratios when you're analyzing a company, but I focused only in the key ratios. You can obviously use other ratios as well. So, Akhilesh had told me that you guys, have some, DCF. So DCF is a fairly complex topic, which takes you at least, 2 to 3 months to learn and takes you 20 years to implement, because there are just so many assumptions in something called a DCF. It's called the discounted cash flow. So what is a discounted cash flow? Basically, every company makes some money. They make something called cash flows. Those cash flows we have. So as an investor, when I'm buying that company, I have to at least know a range of what that company will make over the next 2 to 3 years. So that is called your future cash flows. Those are called. So I have to try and understand a company like Tesla, what type of money they'll make in the next 3 years. Based on that, I'll either buy this company or not. Because if I can't predict that, there's no use buying this company. You just look at Tesla's product and you'll say it looks good. But what if the product does not make money 2, 3 years down the line? You have to realize, how good the product is, and based on that, you have to derive a cash flow from it. So the present value is the current value of the future sum of cash flows. So basically, there's an example also in the next slide. So just bear with me about the definitions. And in cash flows, there's something called a discount rate. So it's called discounted cash flows. What is your discount rate? Is the expected return that from the company. So if it's a Walmart company, a company that makes say 7 to 8% growth rate over every year, your discount rate will be 7 to 8%. Whereas it's say an Amazon or Tesla that is growing at 15-20%, your discount rate will be a little higher, because when it's growing also you're assuming a much higher risk. Suppose the growth does not turn up as high as you expect it to be. That is why you give a higher discount rate in your DCF model. And there's another way to derive a discount rate, which is a little more fairly complex compared to the thumb rule I gave you, is your weighted average cost of capital. So what is your weighted average cost of capital? It is basically the cost of your debt. That is when you're building a business, you take on debt from the bank. And your second is your cost of equity. Cost of equity is the money that you put in your business or the shareholders put in your business. For example, you start a business and your father puts money. So he puts in, say, you start a business and he puts in $1 million. So that is your cost of equity. And then you also go to the bank and tell, see, my dad's put in $1 million, you guys put in another $1 million. So that is your cost of debt. So those two things make up your weighted average cost of capital. So very logical. Your cost of capital is your money that you're getting from someone. So this is basically a very fairly basic DCF model. As you can see on the left, it's included all the things that I've discussed: your revenue, your EBITDA, your EBIT. EBIT is basically you remove depreciation and you get an EBIT on your, and on the left is your accounts. The AR stands for accounts receivables. Then there's inventory. Then there's accounts payables. Then there's something called capex. You know what is capex? Capex basically is your capital expenditure that you do. Capex, now SB Gen, wants to build a new campus in New Zealand. What they do, they have to build a building, right? Or they have to hire someone to build a building, or they have to lease a building. So that comes under your Capex. So the money you're spending to earn additional revenue is called Capex. So this is a very fairly basic DCF model. I don't expect you guys to grasp anything that is here. But whenever you see a DCF model, you should realize, what all, where is what on your left. All these are balance sheet ratios plus your profit and your income statement ratios. On the right is your weighted average cost of capital. So as I said, right, your cost of debt, then you take a tax rate, you reduce that tax rate, you get your after tax cost of debt. What is your, that is the money that you're taking from your father, the money you're taking from the bank. Then your equity is the money you're taking for your father. And you take the weighted average. Weighted average is just a formula wherein if your debt cost is higher, your weighted average will go a little towards that end. And if your cost of equity is higher, your cost of equity will go towards that end. So I'm sure you'll all know what is weighted average. It's basically a very fairly simple formula that you apply. So this is a DCF model. In a DCF model, you're predicting, the revenue for a company 5 years down the line. So this is when you're actually, as an analyst, like where I work, we have to be experts in the field that we are operating. Say I'm a analyst in the cement sector. So I'll pick up a cement company. There's a cement company called Ambuja Cements in India. So I'll look at that company. I'll look at the past. I'll look at their balance sheet. I'll look at their profit and loss. I'll see how they were doing, what they were doing. Then I'll go and I'll, go a little, look forward. I'll read some reports. I'll say, okay, cement sector is expected to grow 10% in the next 3 years. So then based on that estimate, I will go and look at Ambuja's revenue. I'll say, okay, if the cement sector is going to grow at 10%, these guys will grow at 7% because their market share is not too high. Then based on their revenue, I'll go and figure out an EBITDA. Then based on that, I'll take a margin. So, this is fairly complex, but as you start doing this, you'll get practice of it, and it becomes easier down the line because you become a subject expert. That is, you become, really good at the cement sector. So it's easy to predict as well. So this is a DCF overview that I've done for you guys. I don't expect you guys to know too much of it because it's fairly complex and it'll take time to understand, because I've been working for the past 5 to 6 years. It takes me more than 2 to 3 years just to understand how to predict cash flows. So it will take time. So, basically as an analyst, what we do, how do we invest in a company? So I told you we study the industry first. We look at Ambuja Cements. We look at the cement sector. We'll see how's the cement sector doing. Is it growing? Is it going down? How's the outlook for the next 3 to 5 years? I go pick up an industry magazine for the cement sector. I read that. I talk to people in the cement sector. I go and attend conference calls held by, experts in the cement sector, and I try understanding that way. Now we'll try to use an example for this, and I thought I'll use Tesla in our example. So, is this a good business? What are the key success factors to superior performance in this industry? Can anyone tell me what do you think is the key success factors for Tesla in their industry? Anyone, just wild guess. Yeah, audience, unmute yourself and say it.
Being the first major player in the industry gives them that advantage.
Correct. That's one advantage. Any other advantage? I saw a chat. Someone, innovation. I think innovation is one. Being ahead of the curve. That's correct. And finally, it has to be a good car, right? More than anything else, you have to make a good car. Even if you make a good car, if a customer wants the order in the next 3 months, you have to deliver it on time. Because if you're not delivering it on time, the customer will go and talk to someone else and they won't be happy. So you won't get further orders. Design value for money, absolutely right. So these are the key success factors in the industry. Then apart from that, Tesla needs to have charging stations. If there are no charging stations, if you go on a long drive, how will you charge your car? Yeah, Akhilesh, you're raising your hand.
Yeah, I think its success is also due to the fact that it absorbed many losses throughout many years. So, determination and constant funding.
Correct. So you have to keep on investing into innovation. That is why, it takes so much time to develop a car. Absolutely right. So then you define the market opportunity and how do competitive products address this opportunity. So when Tesla entered the market, there was no one, right? They were one of the first guys to mass produce electric vehicles. And many of the companies were still on, the internal combustion engines. So right now, from a simple Google search, the total the electric vehicle market cap is close to $33 billion. And there are hardly a handful of companies that are addressing this opportunity. Whereas, there are totally close to 100 crore, normal price, passenger vehicles in the world right now. So close to 1 billion passenger vehicles on the internal combustion engine are still there. So this is a big market opportunity for Tesla, right? Even if 10% of these, the current cars that are on the roads convert to electric vehicles, it makes a big opportunity for Tesla. So this is how you'll derive a revenue for Tesla, based on the market opportunity that they have and the market opportunity that they can tap. So that is very important to understand. Basis for your top line, that's your revenue. Then who controls industry pricing? Does the company sector have any pricing power? What do you guys think?
Yeah, Tesla has very strong pricing power as they're the biggest player in the market.
Correct. Yeah. So, if Tesla reduces prices, everyone else has to reduce prices. But if a Volkswagen reduces prices, will it matter to Tesla? No, because they're number one. Everyone will still go for Tesla. So it's very important to understand who controls the industry pricing. Similar way in a cement sector, if the leader reduces prices, everyone else will have to reduce prices because they have to compete with the leader who gives much superior products. So it's very important to see who controls the pricing. Now we go down to the business model. So we are starting from a top-down approach. So top-down approach is basically you start with the industry, then you go to the company, then you go to more smaller factors. So we are doing that as of now. Why is the company good or bad at what they do? As discussed, it's innovation, ahead of the curve, investing heavily at the start, on-time delivery, charging stations. So you really need to understand this is called qualitative research, wherein you go and read as much as you can about the company to understand what will the company do and how will it benefit them going forward. So, Tesla is actually a good example. Can they sustain it? So there are many companies that are not able to grow, say, more than 7 to 8%. So what they do, they go and acquire another company and suddenly they start growing. There's a company that we also study called Valiant Pharma. So Valiant Pharma basically is a pharmaceutical company that was doing well, 10, 15 years back. But then they reached a place where there was no growth. So what they started doing, they started acquiring other pharmaceutical companies, and whichever medicine or whichever tablet that pharmaceutical company produce, they just increase the price of that. So if there is a medicine for kidney stones which was $1, they buy that company off and they increase the price to $5. That is very negative because that creates a lot of backlash for your company, and you have to be very mindful of companies that are growing via acquisitions, that is acquiring other companies. That means these companies are not able to sustain their own growth rate, so they have to go outside and spend money to buy other companies. So it's always, whenever you see a company that acquires another company, there should be a light bulb in your company. Why is this company acquiring this company? What is the reason? Is the company slowing down its growth? Is the company trying to hide something? So always remember that.
So at
So
that point, I'm sorry, just wanted to add. So Facebook in the last 10 years has been acquiring companies left, right, and center. So does that growth rate, is that from acquisition, and is that like a bad sign?
So see, Facebook's business model was first only Facebook, but there also you reach a saturation rate wherein now the number of people you keep on adding keeps the growth rate keeps going down. So what Facebook does is they'll acquire products in a very or acquire companies in a very similar background. So when they acquired WhatsApp for $19 billion, everyone was like, it's a very stupid acquisition. But you also have to see that Facebook has enough cash on their balance sheet to acquire such companies. There are companies that take on debt and they acquire other companies. So that is the negative that you see. Then Facebook acquired Instagram for 1 billion. After acquiring the company, it's very important to see what the company does with that acquisition. Because Valiant Pharma, what they were doing, they were just buying the company and increasing prices. Facebook was not doing that. Facebook was acquiring the company, They were reskilling people over there, putting new people on the board, and increasing user base. And it's a platform for them. See, tech companies are very different in acquisitions compared to, say, a normal company, because tech companies have a platform. Now Facebook has Facebook, WhatsApp, Instagram. All three things are almost integrated, because you may have realized also, what you chat on your WhatsApp, you suddenly get ads for that on Facebook. So this is an integration of their platform that they're done. So it is actually a positive for them. So you also have to see how positive it's for the company that's acquiring it, and can they integrate it into their platform. And tech companies are again very different compared to your normal old industry companies like pharmaceutical, cement, and all. So I'll go on to the next one. So as we discuss valuations, simple market cap upon PAT, that is your the total worth of the company upon the profit the company makes. Then your EV EBITDA. For companies that are not making profit and have high debt, you use something called enterprise value upon EBITDA. Enterprise value is your market cap of the company plus the debt of the company minus the cash the company has upon your earnings before interest, tax, depreciation, and amortization, also known as operating profit. This is the core money the company is actually making before other expenses that are your interest, tax. Market value upon sales. So sometimes, when the company just starts, especially these VC investors, if the company has finished, say, 1 to 2 years of operations, they use their market value upon sales, because there are no profits for the company, neither are there any EBITDA for the company. So you use something called market value upon sales. If you look at Tesla sales will not even be maybe 10 to 20% of Toyota, but Tesla still has a much higher market value compared to Toyota. Why is that? Because they have high growth rates. It's a futuristic product that they're making, versus Toyota that is just doing the internal combustion engines, and they're growing very slow. So these valuation ratios are very subjective, and you really need to have to read a lot on them in order to understand how to implement them, because it's basically just a formula that you input on Excel. But real investors, what they try understanding is how to interpret them. That is very important. The formulas are very easy, but learn to read how market value upon sales impacts the company, or how you can, as an investor, understand what this signifies. So then when you're valuing a company, you have to see what their growth rate is. Tesla, high growth rate, high value. Toyota, low growth rate, low value. Simple. And finally, everything is rosy, but when you're investing, you really need to know the risks of the business. What are the risks of the business are very important to see. What are the big unknowns for Tesla? Okay, Tesla's run is a one-man company, Elon Musk. What if something happens to him? The whole investment thesis goes for a toss, because he's the one that's driving this company. So this is something called key man risk, wherein there's only one guy driving this company. Suddenly something happens to him. Suppose he gets into an accident, God forbid. What happens to the company? Who leads the company? So it's very important to know who's running the company, how are they running the company, how is the management of the company, are they delegating work properly, or is there only one guy leading it? Because if something happens to that one guy, the whole company is gone. So how recently we have seen that Jeff Bezos, has given the mantle of CEO to someone else. So that's really positive, because he's letting someone else run the company, and he has other philanthropic activities. So it's really good to see how another person can run this company and take it forward. So very important to know the big unknowns. How much can the company control, influence these risks? What causes events to be a total? How bad could it be? So this is simple, right? You need to understand, what are these risks, and how impactful these risks can be. Sometimes it's just, now Tesla drops prices. That's a risk, but it's okay, because other companies will drop prices as well. Whereas Tesla's major factory catches a fire and the factory is destroyed. That is a big risk, but that's an unknown risk which you can't, predict or anything. But you still have to account for those type of risks. And a simple example is newspapers. 10 years back, everyone used to read a newspaper. In 2009, you were like, wow, the newspaper companies are going to do well the next 3 to 4 years. But suddenly new technology comes in and they're screwed. They're finished. You read everything on your phone right now. So these risks are very important to try and assess. And you'll know these risks only if you read about that sector and that company, and what are the trends. So that as an investor, 90% of my time or our time is only about reading. We come to office at 8:30, start reading. The market opens at 9:15. We track the market for maybe half an hour to 45 minutes, go back to reading, and reading what trade journals, reading the annual reports. I'll come on to the next slide on that. Reading annual reports, trade journals. So if you want to be a serious investor, you have to read a lot, because that's when you build your mental models. That is when you'll understand how a company functions. and that will help you build your base in investing. And you'll be able to talk to other investors in terms of how do you look at this company, why do you like this company. So read as much as you can if you want to really get into the investment business, or if you want to invest in a company as well. So, sources of information as an analyst, so this is your primary source. So, what you should do, you should take these big companies like Tesla or Amazon, just Google their annual report and read the letter from the chairman to the shareholders. This provides you a lot of clarity on the business, because in this, they provide, how the outlook was for the last year, how was the performance for the last year, what is their outlook going forward. So this should always be a basics. If someone tells you, okay, I want to read about this company, or you want to read about a company, you go, the first thing you do is open the annual report. And investors like Warren Buffett, they read annual reports for the last 10 to 15 years. So you can imagine how much reading that is. That's easily 10 days worth of reading for you. So they go, they read the annual report, they look. So now what they do is, now so Warren Buffett, he'll go to the 2010 annual return, and he'll read what the management, or what the CEO has guided for 2011, 2012. Then he'll go to 2011, 2012 and see if he's achieved what he said in 2010. So as an investor, or as in your case study, you really need to know what they said in the past and have they achieved that in the future. Objective and goals. Next is newspapers. You should really, I think SP Jain has a subscription to the Financial Times. You should really use that, because I hope you guys are using it. That's the first thing I did as soon as I got my login details from SP Jain. You really need a global perspective. You're doing from a global school, so you need a global perspective, and reading the Financial Times will give you a really good view on what's going on in every part of the world. And if any of you have read Financial Times, there's a big thing going on. This company called Greensill Capital. Greensill Capital is one of the largest supply chain companies in the world, which has been funded by SoftBank. I'm sure you all know what SoftBank is, and that company has gone bankrupt now. So this small bankruptcy can create ripple effects all over the world, because the largest supply chain company in the world goes bankrupt. Suddenly there are 50,000 people out of jobs. So you really need to read and get a perspective on what's going on, especially so that especially in your job interviews, right? People will ask you, so you really need to know and be informed about what is going on in different parts of the world. And now, if you really want to get into how a company functions and what they do, there's something called brokerage reports. And I'm sure you'll heard of companies like Goldman Sachs, Morgan Stanley, UBS, Credit Suisse. These companies come out with 100, 200 page reports on companies, wherein they go really in depth into the company. And you read that 100 page report, everything that is to know about this company, and you'll be able to make a very good decision whether to buy or sell such a company. And that will really help you in terms of your investment case study. I don't know what type of investment case study you're going to get. I think most probably it will be some company based in Israel, or it may be a global company. But all these three things apply to that, because you have a lot of information on listed companies. It's very important to read as much as you can on them. And what is important as well, not only just read any random article, but you have to see what is important for your investment thesis or your case study, and make it, because as an analyst, if you're working at a investment fund, you have to present a case to your boss every 2 to 3 weeks about a company, and you have to tell him whether you like this company or not, and why you like this company or not, and where will you get the information from. You'll get from these three sources: that's an annual report, newspapers, and your brokerage reports. Very important to understand the business model of a company, understand where they're making money, where they're not making money. And there are many companies, like I'll give you a certain example, a car dealership. You must be thinking these guys make money from selling cars, but they do not make any money from selling cars. A car dealership makes money from selling accessories to you. On a car sales, they make 1 to 2% profit margins, but on selling you the seat covers, your mats, your the visors on your car, the designs that you need on your car, those guys make 300 to 400%. So you really need to understand where the company is making money. Tesla also right now, is actually not making a profit. How are they making a profit? They have something called carbon credits on their balance sheet that they're trading. So basically, they're a green company. So they get carbon credits that they sell to other companies that are not as green as them, and that's where their profit is coming from. Their profit is not coming from selling cars as of now. So very important to go in depth and understand what is going on in the business. So these are some recommended readings that when I started investing, I have read these books. Peter Lynch, One Up on Wall Street is a very nice book, which you guys can understand the basics of the stock market and what is investing. Basically, what I have this synthesized in the last 45 minutes may not go into your head, but if you read Peter Lynch's One Up on Wall Street carefully, that one book is really good for you, and you'll think in a much different way. So when you go to a supermarket, you'll really look around and see what companies are doing well, what companies are not doing well, and that's where you'll find out and you'll understand about different companies. And then there's this fund manager called Joel Greenwald. You can be a stock market genius. Don't go by the title. You won't be a stock market genius, but you'll learn a lot from this book. And in the night, if you don't feel sleepy and you really want to sleep, there's a book called Security Analysis by Benjamin Graham. This book will put you to sleep very fast. But there are investors that swear by this book. Benjamin Graham is basically Warren Buffett's guru. He learned under Benjamin Graham, and Benjamin Graham has written this book in the 1960s. So it's a little heavy on you. So if you guys are interested in investing, not sleepy in the night, just go through this book. Within 10 minutes, you'll fall off asleep. That's what happened to me. That's what I'm telling you guys. So there's actually a quiz, but first you can, ask me any questions that you have, and whatever you want, you can ask me.
I've got a question. So how do you predict whether a company is going to be the next Tesla, the next big thing, the next Amazon? How do you predict?
That's a question that no one has an answer to, but
I mean, what are the tools that you could use?
yeah. So the first thing, if a company wants to be the next big thing, you have to see who's running the company, because you have to see his past record. Elon Musk, before Tesla was, in a payment company that did very well, PayPal. Before that as well, he had a startup that he sold. So it's very important, if you want to know the next big thing, you need to know who's running the business, because that guy is going to spearhead it. Because financials are not going to tell you anything. The guy who's running the ship, the guy who's, behind the car, he's doing that, is that guy to find out the next big thing. Mark Zuckerberg, why did VC investors put money in him? He's a Harvard dropout, but the way he built Facebook, he's the guy that ran everything. So that's why they put money into him. So it's very important to see who the guy is. Then the second thing is your financials. You come on to that. But if you want to know the next big thing, you see the guy who's behind it. And usually it'll be a dropout. Like there's Oyo, for example, he's a dropout. Paytm in India, the guy is a dropout. So it's very important to see how the guy is, what's his drive, is he passionate about what he's doing, does he have other businesses that he's running, can he put in 100% in this business. So it's very important to see the next big thing is to see the guy who's running it.
Yeah.
The chat. Will new entries to market affect the existing company? Example, Apple entering the vehicle industry. Will new entries to market affect? Yes, of course, there will be effects in the industry as well. So Tesla, when they entered the market, all the normal Toyotas, the Chevrolets, they all, wrote them off saying that this guy doesn't know anything about the automobile industry and he's entering the market. So yes, it will affect existing companies. Any new player that comes into the market will affect, and it depends how big they come in. The easiest example is Reliance Jio in India. When they entered the market, they came with a bang. For 6 months, free internet, free voice, everything is free. Obviously, if you are a customer, you're going to go for that. Then obviously Vodafone Idea could not match that, though that company is almost bankrupt. So yes, it's very important to see who's entering and exiting the market, and that will help you understand about the future prospects of your company.
Thank
Hey,
you. Sorry, go on.
I have a question. Acha, okay, sorry. Yeah, so this was a great session, but I don't know if my question will make sense, but I just wanted to ask if most companies that end up disrupting don't really have really nice financial ratios, probably. So why do we put that on such a pedestal? Like, why is it of so much importance? Like, shouldn't our analysis just be like more qualitative, based on how well they're like, I don't know, how creative they are instead of just like the financial ratios?
Yeah, that's a very good question, because see, qualitative is one aspect. One guy can come and sell you his story saying that I will make $1 billion in the next 2 years, but you really need to go into the numbers, right? I'll come and tell you, okay, I'm starting a company, I'm going to make $3 billion in the next 1 year. You'll be like, wow, take my money. But if there's no financials, how do you know if he's really going to make money or not? And also, you really need to go into the numbers to understand. Because see, Amazon, for example, in 2008, 2007, the financials were shitty. But the guy running it was very important. And you really need to understand the financial. See, financials is good for companies that are mature. You're talking about companies that are creative, is more in companies that are just in the initial stages of conception. That comes under VC investing, which is a whole different ball game altogether. That depends. You're right on how the guy is. That's qualitative. But if you're investing in the stock market, you need to be quantitative because it's all numbers. Why it's numbers? That's how you value companies. See, Tesla is a beautiful company, creative. The stock price was $700 2 weeks back. Now it's around what, $600. Based on the creativity, you can't just pay $700 for that stock. You need to go to the financials and see if it's worth $700. Are the ratios worth the price of $700 or not? So that's when your financials come in. You need to know what the company is worth versus what the company is worth in the stock market. That's when, as an investor, you come in, right? Tesla is worth $800, but I know it's actually not worth $800. With my financial analysis that I do, I look at the ratios, I look at the balance sheet, I plot the free cash flow for the next 5 years. That will tell me the company is worth only $500. So I'll say only if the company comes below $500, the share price comes below 500, I will buy that company. So that's a very good question that you said, but you really need to back it up with numbers and not only the creativity, because creativity can go wrong, but numbers usually tell you the real picture of the company.
Is there any way you could like quantitatively analyze what you want to analyze qualitatively? I don't think there are any ratios for that.
Yeah, so for
But then
that, you
you
need
should, but that's just something you predict. So yeah, makes sense. Yeah, I got it.
Yeah, but also you can have frameworks for your qualitative analysis as well, wherein you have, qualitative is very subjective. So for one guy, this guy may be a genius. For me, he may be just talking rubbish. So you'll need to have your own framework for qualitative, and that's where your creativity comes in. Because quantitative, after a point of time, everyone can do, but qualitative, not everyone can do.
So all in all, at the end of the day, investment is just like making predictions.
Correct, absolutely right. Because you're buying a stock thinking that the company is going to do well the next 2 3 years. So you need to understand if the company is going to do well or not. Investment is not based on past. Investment is based on future. So that's the main thing.
And then you analyze financial ratios just to make the best prediction.
Correct,
You
absolutely right.
potentially could. Yeah, cool.
That's
Thanks.
So is it, someone has asked, Loka Nayaki has asked a question, is it safer to invest in ETFs for beginners? Yes, absolutely. It's very safe to invest in ETFs. I wouldn't say your capital will appreciate always, depends on market conditions. But it's very easy to invest in ETFs or mutual funds, any one of them. ETFs are, yes, very cheap. The expense ratio will be 0.5 to 0.6%, whereas mutual funds, you end up paying 1% to 1.5%. So yes, it's very safe to invest in ETFs. And always have a long-term horizon. Don't get into trading. Trading is good when you have small amounts of capital, you can lose that. But investment, always have a long-term horizon. If you're buying an ETF, you stick to it for more than 1 year. That's when real money comes. You don't make too much money in trading. I'm telling you because I've been doing it for the past 7 8 years. So trading is a very difficult thing. Don't get into quick money. No one makes quick money. Whatever you make quick goes fast, goes out even quicker. So be very careful. But yes, ETFs are the best place to start for beginners like you guys.
Thank you. My question was, I got Benjamin Graham's this one, The Intelligent Investor. But as you rightly said, 3 pages and I was fast asleep. And it is a bit old, a bit redundant, language is quite difficult. So to fasten the learning growth, where do we look at? What do we exactly read out of this? Because a lot of it is quite fluff.
Yeah, that's why, I think Peter Lynch is a much better author that way. So you should really pick up his book, One Up on Wall Street. I finished reading it in a day. If you're passionate about the market, you'll finish reading it in 2 days, because it's very light. Because security analysis is a really heavy book on your brain, and it doesn't make sense to read it right now. Maybe if you understand more about markets, then you can read slowly. But One Up on Wall Street is a very good book to read. And there are a lot of blogs, online. You'll find a lot of stuff online which will help you in your investing journey. You can email me and I can share some of that. And get onto Twitter. Twitter is where the investors are, where people are sharing really good content. And that's a good place to, fasten up your learning process about companies. And you should really start, instead of security analysis, start with one up on Wall Street, and it'll change your outlook really well and will help you.
Yeah, and just for the members also, like most of us have the Financial Times app and we read news, and especially for me, I'm just reading about politics and economy and world affairs. But for this investment, what exactly channels or authors should we be subscribing to? Because Financial Times is really wide.
Correct. It's see, Financial Times again is very broad. So they have something called FT Big Read. Sometimes that comes on specific companies. See, newspapers is more for your broad horizon. Newspapers you won't get too much on companies. You'll only know, okay, this company is doing well, this company is not doing well. What are the reasons? But if you really want to get to know companies, you have to read annual reports. That's newspaper is like your filter, right? You start reading about a company, you say Amazon, so suddenly your newspaper article comes, say 10 years back, Amazon posts a profit. So that's when your bulb should click, say, okay, this company is doing well. So now I go down to the annual report. I read the annual report. Why are they doing well? So newspaper broad, annual report, brokerage reports more narrow.
Got it. Thank you.
So any more questions from you guys?
Yeah. Yeah. Good. Sorry. Hi, Ronit Amarian. And I watch CNBC TV 18. It's a fun channel. I mean, I watch it a lot. And yeah, I had a question, in a little Indian context, right? I've read all these books and stuff of that sort, Intelligent Investor. But previously, while explaining, you mentioned as the company gets bigger, it finds itself harder to grow, harder to compound its earnings and revenues. But in India, you have these certain exceptions. I think you'd be knowing about that coffee can portfolio of Saurabh Mukherjee, where he picks up massive, large companies which are compounding massively. So in a case of that, these companies trade at like stressed valuations. You've got 60, 70, 80 Ps. In that situation, like, do you think that'll turn out good? Because the price will compound relative to the earnings itself.
Correct.
But whenever you read any of these books, it's always buy the cheapest company ever. And it's a complete contradiction. So what do you think about that?
So see, this depends on the market condition you're in. If in March 2020, if you applied Benjamin Graham's analysis, you would have made 3, 4, 5 times on those companies. But if you bought those expensive, like an Asian Paints, or I saw Mukherjee just said Asian Paints, HDFC Bank, you would have made maybe 50% to 100%. So it depends on what type of market you're in, and what type of sentiment you're in. So I'll give you an example of what can I give. So these small companies, like there's a small company called, not important, DCM Shriram. So if I applied Benjamin Graham's analysis to that company was trading at lower than its book value, lower than the operating cash flow, that's the EBITDA, and I would have made at least 3x on that stock. But if I bought what you were saying, an HDFC or a coffee can, yes, I'll make money, but the multitude of money you make will be very different. The multiple will be very different. And right now, the Saurabh Mukherjee, if you see, he's when he started his own asset management company right now. So he's focusing more on these mid caps to small caps. Then he has 2 funds right now. So one is the large cap fund wherein he has his coffee can investment, and the other is the small cap fund wherein he's focusing on these companies that can actually compound capital at a much higher and a faster rate. And recently, I was just reading an article today wherein he's bought a company called ICICI General Insurance. So that company again is a mid-sized company, one of the market leaders in India in terms of your vehicle insurance. So, your investment style has to keep on changing. Like even Saurabh Mukherjee, investment style is not the same. It has to constantly evolve and change. If you remain with the same investment style, you will at some point not make money. So that is why reading is what, as Saurabh Mukherjee also says, you have to read, and, understand different mental models.
So that completely answers my question. So situation definitely changes your strategy. Now, just, I'm sorry for everyone else. I'm just adding another question to this itself. So in India, whenever you try to go for a Benjamin Graham type of company, you end up looking at companies where the promoter is a thug, or probably you can go through and the accounting doesn't seem legit. Obviously, the first 2 formulas and you can find out. So in that case, like, how do you think we should go about it? Mid caps, small cap?
See, as soon as the promoter is a thug, no matter what the valuation is, you will not even touch that company. Because once a thief, always a thief. That is the philosophy that we follow as investors, right? Because you don't know where your money is going. It's very easy to siphon off money from a company. You just increase your expenses and the promoter siphoning off money. So always low PE does not mean good. High PE also does not mean good. It's always relative. Always look at what the sector peers are trading at. Who runs the company is very important. So those are multitude of factors. But yes, you should not touch companies where there's a thug, or you think there is a slight problem. Because a simple example is Z Entertainment in India. The company is really good, but the problem is the people who are running the company, they branched into too many businesses and the money went all over different companies and they got screwed. So the company may do well, but the guy who's running the company is very important. So if he's a thug, you really need to stay away from such companies, no matter what valuation they trade at. Yes, you may make money obviously if you buy at the lows, but then your risk reward is not favorable for such companies.
Very interesting. So I'll just pass it on to whoever next wants to ask a question.
So I have a question. It's a very basic question. I'm just starting to understand about investments very lately. So my question is, how do we know the valuation of a company which is not yet listed in the stock market?
So yes, that is a very subjective valuation. Basically, if the company has raised money in the last 6 months, you'll get what valuation they've raised the money at. So this you can't find out easily, because if they're not listed, you will not get information on such companies. Financial information, your information will be limited to the newspaper articles that come. So yes, it's very difficult to get valuation of such companies, but as soon as they raise money, you will get the valuation of that company.
Okay, thank you.
And if you're a private equity investor, that is a company that invests in private companies, you will have that information on hand because you have a network and you have people that you talk to. But as people who are students or outside the market, you will not get these valuations that easy unless that company has raised money in the last 6 months to 1 year. So like Oyo has raised money, so suddenly the valuation is $10 billion. So it's 10 billion. But if they didn't raise money, you will not know the valuation. So it's not easy to get valuation of such companies.
Okay, understood.
I had a question regarding investment in smaller markets. I'm from Mauritius, so I invest in the Mauritian market, and the market size itself is very small, and the amount of liquidity in the market is very small. So, in terms of ratios, I don't think we can apply the same knowledge that you just explained to us because the dimensions are different. So, what other factors do you advise me to look at when investing in such a small market where you have, for example, the healthcare? It's heavily dominated by monopolies and all. So what are the factors I should look at before investing?
See, small markets, again, if there are monopolies, like in Dubai is a small market, controlled by 2-3 players, or Mauritius, again, as you said. For a small market, the first thing is you have to see what is the GDP growth rate of that country. If the GDP growth rate is high, then only the companies will grow well, because finally companies grow at the rate or maybe 1.5 times the rate of your GDP. Then once you finalize down to a company, right, you see if that company is a monopoly or not. If that company is a monopoly, you just blindly invest because there's no other person that's going to come in that market. Because such a small market, such markets can only accommodate 2 or 3 players. So your investment also, investment horizon also reduces, or the type of companies you can investment reduces. So that's when you have to branch out of your country and invest in US or China. And that's when actual real money will be made, because Mauritius, small country, small companies, growth rate is small, population growth rate is not high, depends on lot of tourism, if I'm not wrong. So suddenly COVID comes, they get screwed. So we really need to diversify out of small countries and invest into emerging economies.
So you don't advise investing in developing economies? Because based on what I read online, like a lot of investors are saying the US market is currently in a bubble right now. It's not supported by their book value. Their market value is not supported by their book value. So they advise people to take their money from US market and invest in developing markets like Vietnam or other Southeast Asian countries. So how does that work in terms of what are factors these people are looking at before investing in those developing markets?
Correct. So, as I said, emerging economies, Mauritius is too small for, big investors to invest. Vietnam is too small, but yes, they will invest. See, I'm a global investor. I will allocate 70% of my money to US, because US I have liquidity. I can exit whenever I want. I can invest whenever I want. Emerging markets is not the case, because you can't invest that easy, you can't exit that easily because you have no liquidity. So that is why even if US is in a bubble, global investors will always have a high allocation to US and a relative smaller allocation to emerging markets. So emerging markets are good to invest if you have small amounts of capital. And also emerging markets, again, you need to really look at the GDP growth rate, what type of policies they're getting, why Vietnam is ahead right now in textiles and manufacturing, because they got in really good policies that freed up the market. Why is Taiwan, the leader in semiconductors, because Taiwan has access to resources. So in all these emerging markets, you have to see what type of resources they have, how is their GDP growth rate, and most importantly, how is the political situation. Vietnam is doing well, China is doing well, one political party. No one can go against it. No one can destabilize the reforms that they get, versus say an Italy or a Spain or a Brazil for that fact. Brazil actually is a really large emerging market, but politics is a problem, right? Suddenly, there's Bolsonaro doing really well. Suddenly he's out of power and a left-leaning prime minister comes. If you're left-leaning, you'll want to privatize everything that's there on the planet. But yes, you're right. You really need to look at emerging markets. But again, the largest market is US. So that's where the largest allocation should be. And US GDP $20 trillion, China 12 trillion, India 2.5 trillion. Rest all are less than 2.5 trillion. So why would you want to invest in such economies or small you can put a percentage allocation, but again, global investors may say it's a bubble, but they'll still have their money in US because that's where the real money is made.
Oh, okay, thank you.
I had a question on a career in investment versus a career in venture capital, and how does one go about it?
So see, venture capital is like a business where I throw money at 100 people, and that one person will return me that money that I threw. So there'll be 99 people who I'll lose money with, but that one person I throw money on, he'll give me 200 times my money, and he'll cover for the losses of other businesses. So venture capital is basically betting on the person running the company, because he just comes to you with an idea, and you have to figure out if that idea is good or not, and the person running that idea is smart enough to execute that plan. So Tiger Global, one of the largest VC funds in the world, how do they, decide whether to invest or not in a startup guy? They look at his GE scores, which he got into IIT with. So there are a lot of factors apart from the business that they look at in venture capital. And getting into venture capital is it's not difficult to get into small venture capital companies, because they're doing well and they're expanding. Whereas looking into say investments in public markets, you're looking more, it's a lot of quantitative stuff, looking at the financials, understanding very mature companies. So in public markets, you're looking to only double your money in 3 years. That's around 25% CAGR, versus venture capital, you're looking for 10x or 100x or 200x investments. So it's a very different mindset that you need in both. So venture capital cannot become a public guy, or a public guy cannot become a VC. It's very difficult. Both mind games are very difficult, and getting into venture capital or public markets is based on your networking. It's all networking, because no one comes to colleges and recruits unless you're from the top one or two colleges. You really need to network yourself out and talk to people. And LinkedIn is the best place to message people. And don't directly ask them, I want a job, right? You tell them, I want to pick your brains, I want to understand how you choose companies. And a lot of these VC companies called Anderson Horowitz, ABZ, and a couple of other VCs, they have where they publish their thesis on their companies on their website. So after say a Shopify, which they must have invested in 2010 or 2011, they publish the whole thesis of why they invested in such a company. And then you'll understand, the thinking behind it. So need to go understand and figure out what type of mindset you have. You have a VC mindset or a public market mindset. So yeah, you network, you will get in. It's not difficult, but it's not easy either.
Yeah, thank you for that. I was kind of trying to pick up brains of someone at Sequoia Capital in Bangalore and Khosla Ventures and all, but it was really difficult to crack in for sure. But thank you for this. Maybe you could, in the next session, you could tell us about targeting this really premier VCs and how do you get around understanding their businesses and making connections that way.
Correct. Yeah, it's an art, as I think one of the girls highlighted. It's all qualitative. You need to use your brains. There's no specific formula, but it also depends on your mindset and on your passion. Yeah, because in your interview, right, they're gonna ask you what have you read. they're going to ask you about different businesses. So you have to be prepared. You have to read a lot. So when I go for an interview for a public market, they'll ask me what stock do I like. They'll not ask me what are my strengths or weaknesses and all that bullshit. They'll clearly ask me what stock do you like, why do you like it, and they will answer back telling we don't like it. You prove it to us why we should like it. Same thing in VC. They'll ask you what has been the recent deals. What do you think of those recent deals? So if you want to get into that, you have to read and you have to remain updated. That's the only way to crack such companies. Versus say if you're an engineer, you'll go and build something. That's a very a job where you don't need to keep on reading. Yes, you need to read about your industry, but in VC and public markets, just read as much as you can, and you need to know about different businesses. As an engineer, I know only one business, the business I am in. I'm in L&T Infotech. I will know only L&T Infotech. I'm a VC or I'm a public market guy. I need to know multiple of business, how such a business runs. And that's where, as a VC, you add value. As a public market guy, you add value. The only way you add value is understand different businesses, read about different businesses. That's all you have to do.
Thank you.
Are we on time? Anybody else?
I think you've emphasized the importance of reading in the last 20 minutes, how important it is, which I definitely understand and hope everyone else understand as well. I wanted to ask you about something specific to DCF, right? When you're actually looking at it, it's a very advanced thing, predicting the cash flows. But even when you predict the cash flows, you have to account for a discount rate. And predicting that rate is essentially harder than finding out the cash flows, because if you're 1 or 2 basis points here and there, the entire price changes. So do you think it'll be relevant in the future, DCF?
Yes, of course, it's very relevant because finally, Warren Buffett, all of them, what is DCF? Finally, is predicting future cash flows. And again, the rate 1 or 2%, yes, matters, but you have to be in, you don't have to be, it's not an exact science. You need to be in that range. That's all. You can be up and down, but you just need a range. Say a DCF, you're using a weighted average cost of capital. That's not difficult to get because you're just using the cost of debt and you're using the cost of equity. And the cost of equity changes based on interest rates that are going on. So see, it's very simple. Why does the stock market or the market goes up and interest rates go down? Because your DCF, your cost of equity goes down, your cost of debt goes down. So automatically the stock valuation goes up. So it's all related, and you just need a broad range. You don't need to be exact in DCF because no one can be exact. No one knows what numbers are going to come next year. Even the guy who runs the company doesn't know what numbers are going to come. The main thing is to just be in that range. If you're in that range, you will understand.
Yeah, we're definitely shooting in the right direction rather than hitting the arrow.
Correct, absolutely. And see, no one can predict anything, but you can at least predict how it will be. You don't need to predict what it will be, how will it be. So that is more important.
If anyone else has any questions.
Okay, so
I think those are great questions. We can proceed towards the quiz and concluding it.
Yeah, if you have any questions, you can just email me. I'll share my email ID. So more than happy to. So let me. Okay, so I'll give you all the. I'll just share what ID you'll have to put. So can you see the pin? You go to kahoot.it and you put this pin.
It's interesting. All your tabs are in green, like green. It's almost like seeing profit everywhere.
I don't know. There's some setting that I've done on Google Chrome so that it's easier to read what is on my screen. So see, I have Twitter open. I have this benchmark for some stock market. Then I have some readings open. So all that just keeps going on. Also, what you guys should do, college has access to Reuters. So if you ever have offline campuses, you should go and sit on the Reuters desktop and understand how to use it, because going forward, if you want to get into the investment industry, you will need Reuters. We have 18. Has everyone logged in? All 18.
Yeah, can you guys put your real names, please?
We have Jeff Bezos with us.
Amazing goat, what nonsense. Baron Langrog?
Then just tell me when to start. Because we have Jeff Bezos with us. Hopefully he's the smartest guy in the class and wins.
Yeah, so 20 people, 25 on the call. Anyone having any trouble logging in? Wahoo, are you there? Aditya's just logged in. We'll start in 10 seconds. 10. Devashish, you have to use the game pin. Go to kahoot.it and then put in the number 4262114.
It's a very basic quiz, okay, guys. What I've only done in the PPT, that's only that there's nothing else. So if you're paid even 10% of attention, you'll easily get everything.
Yeah, so let's start in 10 seconds.
Yeah.
Devashish, just give us a thumbs up or something if you're through. Okay, let's start.
Oh yeah, okay, let's begin. I hope you guys have chosen the right option. Oh, lovely. Very nice. Good job, guys. Oh, Josh was in the lead. Oh, looks like That's a trick question. You're going to go really fast in this. Good job, guys. Baron is in the lead. Sure. So now at least you know debt equity, the higher the it's not good. So when you look at a company, debt equity, if it's high, not good. So false.
That's lightning fast. People are just clicking, man. Spam it.
Good job, guys. Good job. Lovely. Looks like everyone paid attention. I'm happy. Guys. Wow, you guys are fast. I give too much time. Weighted average cost of capital, cost of debt, and cost of equity. The guys who put false, remember, never forget this now. Good job. Nice trick question. Let's see how me get it right. Oh, good job, guys. Oh, that was fast. Good job. On equity is not a valuation ratio, guys. It's an operating ratio. Valuation is only PE and EV EBITDA. Good job, Akhilesh. Pretty easy one. Oh, guys, I emphasize on this twice. Operating profit is also known as EBITDA, so that whenever you go and meet someone, if they tell you operating profit, you know it's EBITDA and vice versa. Oh, Abhimanyu is in the lead now. Very good. Good job, guys. Very good job.
It is indeed.
Okay, so last two questions. Just let Abhimanyu know. Lovely.
So she's getting 3 shares of Tesla, 2 shares of Amazon, and here we go. 10 shares.
Good job, guys.
One
So
and only.
Manthan is all going to give you 10 shares of, Amazon or Tesla each, whatever he wants. I think the quiz was too easy. I thought I made a difficult quiz, but I think you guys are too smart for this. So I need to make a more difficult one the next time I see you guys, hopefully.
So yeah, well, congratulations to who did well. I think pretty much everyone got 13 or 14 right. That's fine. Good job to all you guys. Secondly, I'd like to thank Ronit to take out time. We know you had exams last week and you took out time to help us out here and share your ideas. It really means a lot to all of us. I've just put Ronit's LinkedIn in the chat, so you guys can go out and reach out to him and connect with him. If you have any questions, I think they can reach out to you directly, right? Is it cool?
Yeah, no problem. So you can just write me a message on LinkedIn and, you can take it forward. So I just hope you guys have learned, at least the basics on, if you look at a company, what you should look at, and it will help you down the line and at least, make money, hopefully, in the stock market as well.
Yes, I think it's a buffet, so we're probably going to eat it all. But yeah, definitely. Again, thank you very much. If you mind, can we just get a quick picture? If you don't mind, just for a few seconds.
Yeah, others can turn on the videos also. Devashish Aditya Vritti Bahub. Let's take a picture in 5, 4, 3, 2, and 1. Got it.
Yeah, well done. Thank you very much again. Thanks for coming.
Yeah. Thank you, Ronit, for your time. We all are grateful. This
Guys.
is
Best of luck,
very
guys. Thank
insightful.
you.
Yes. I hope the others, their MBA sessions are going on. Ronit is one of the mentors for the MBAs, so you'd be lucky to have him for the investment fund. And group 1 session is today for the MBA session. I hope the rest of the groups are already working with their MBAs and having the mentorship session going on. With this, again, thank you so much for making time for today's, this week's class. And it was fun chatting with you all. Drop in a message to me or anyone if you need. And looking forward to seeing you the next time. Thank you.
Thank you. We shall not leave.
Good session, yeah.
Yeah, nice one, nice one. Let's use some. It was very basic though, so let's wait for Mr. Tory to drop some.
Yeah, because most of them, like, we have first years and second year students, so that's why I kept it basic. Like we cannot, and we have marketing students as well, so we cannot go into technicalities of discounted cash flow and all about you.
I mean, discounted
why.
cash flow, forget that. Teach us how to mint money on stock. Teach me.
Bachu over here. Send me the picture you took yesterday.
Yeah. Hold up. The screenshots?
Yeah.
Oh, okay. On it. I'll have to forward it to you because I just, print screen and I sent to Arun. So I'll just forward. It was a nice session yesterday, though.
It was.
You got one.
All right, I'm gonna head out. I'm gonna get something to eat. Bye, guys.
Everybody, bye-bye. Kavita.
Correct. Ça figure là encore une chose session, non?
Ouais, logique.
Non, les tests caméra, pas les non, pas là, c'est pas qu'il y a de mission que ça fait.
Mais de quoi moi je fais suivre?
Non, mais au moins tu là, tu figures là, on est là.
Porque les quoi ici, moi?
Porque questão aqui, a PC prononce baron à drogue.
Baron Landrug. Viens du HO là.
Et tu vois, maintenant fait un recording vidéo pour tu vois ma présentation. Non, ben, je besoin recorder une vidéo, recorder une présentation, moi, tu en groupe ça. Mais ben, en fait, travailler une erreur ça. Si les parents étaient Victoria, Patricia, Rosita, Vinit.
Ouais, ben là ici, vite.
J'espérais.
Allez, bye bye, nigga.
T'as mangé?
Bon, quoi, ouais, il est un goût là.
Tu peux workout la case?
What of course.
T'es fait, moi.
Push up, squat, a big pull up.
Moi, je prends une bouteille, sur mon PC, faire des affaires. Moi,
Bicep
des dumbbells.
Puis là, c'est pas ce là. Mais ça encore étonné, il a la moitié, il remplit la moitié, fait bicep. Il y a une peu sérieux, fait.
Ah, ça me bon, ça. Après, me prends une tasseuse, me stack une tasseuse, je vais essayer de voir un bench press. Je vais me pousser un peu. C'est essayer, c'est qu'il y a.
Il travaille plus de triceps, c'est mon parce qu'il est serré.
Ouais, mais ça fait
Ouais,
avec. Ouais, non, je fais plus affaires.
On te fait que dans la marine maths.
Tu es, tu as senti, tu as gagné du travail, ouais.
Ouais, ben maths. Pas un sens achievement. Là, quand tu finis les.
Tu fais 100 dans le jour comme je fais.
70, pas là.
Et tu as fait 100 parce que 10 fois 10.
Allez, me maths,
En fait,
je fais ça, je fais vraiment une word, je fais une word, un peu comme CrossFit. Ça me fait pas 15 press-ups, me lever, me faire une bobine gaz, faire 20 squats, me virer bobine gaz, me faire 20 deadlifts, là, me faire 15 biceps décolletés, me revenir, me refaire 15 push-ups, et aller me comme ça. Tu fais, vous allez vite, tu finis à 20 minutes, tu vas finir le corps.
tu veux dormir soit bien?
Bah, arrive bien encore. Rien à dire.
Je me rappelle, pendant un dernier écoute mes jeunes, tu peux dormir, je me connais 4 heures dans ce parti.
Ouais, non, non, mais de chien. Parce que, quand je suis plus libre,
Tu sais, d'argent.
ça me fait là. Arrive, j'arrive casse tout, il y a briefé. Marie donc, mais. Moi, je fais le AI, machine learning, j'ai fait le AI, HI. Donc là, on peut besoin rééditer ce qui me fait. Ouais.
Quel est ça?
Human Intelligence.
Ah.
Intéressant, les MLIS.
Et moi, je crois qu'il tendrait à fixer ce problème la lumière là. Mais ça, là, on dit expliquer, un peu trop tard, bien sûr.
Attends, laisse ça, tu get ça. Un Marie système.
Ouais, mais je trouve rien, mais je trouvais.
Si me fais un gros fan, là.
Non, il est trop creepy, hein, là. Moi, je vais raconter une histoire, un film
Allez,
d'horreur,
correct,
ça.
moi, allez, correct, decent.
Ouais, ça. Tu vois un chien, là?
Hein?
Tu vois un chien.
Ouais, là, on met dans le quelque chose là. Ouais, mais j'arrive avec ça, quand ça veut.
Allez, bonne chance, tu vas en faire, tout ça.
Merci, nous
Tu me
jouons, tu
besoin,
vois.
tu me besoin qu'il te l'aide beaucoup avec un message.
Ouais, là, c'est.
Allez,
Ça,
allez, bye.
maman, tu as une session, là?
Ouais, ouais, un
Tu
gros
veux?
bruit. Non.
Ouais,
Personne
ben,
ne va surfer.
en meeting, on va se rouler, là, maman.
Non, mais quand il est levé, là, on se fait rire. Putain,
Marie
il
Colette,
dit,
là. But tu peux te rouler pour rire. Enfin, allez,
allez,
bye.
ouais.